Morning and welcome. Today we share about financial comparison of three major retailers in Malaysia. The first one is Mr. DIY, Lotus and 7-Eleven. We look at 5 types of financial ratio from 2001 to 2003. Our aim is to compare how they perform, point out their strong and weak areas, assess their financial health. In this presentation, we'll guide you through the result, highlight important insight, and suggest where each company can improve.
Before we dive into the company analysis, here is a brief recap of the financial ratios that we will be using. First, net profit measures overall profitability. Number two, return on assets, which is ROA, assesses how effectively a company uses asset to generate profit. And then, inventory turnover reflects operational efficiency. And then for the next is current ratio evaluates short-term liquidity. Then the last one is a debt to equity ratio measures financial leverage or reliance on debt.
Okay, let's begin with Mr. DIY. It has a net profit margin of 9.1%, the highest among the three. This shows the strong cost control and a solid bottom line. The return on asset is 7.0%, reflecting good use of asset to generate profit. An inventory turnover of 4.8 times indicate that Mr. Daiwa managed stock efficiently without overstocking. The current ratio is 1.3 times, suggesting it can comfortably meet short-term obligation. With a debt to equity ratio of 0.5, Mr. DIY maintains a balanced capital structure and low financial risk. Overall, Mr. DIY is financially strong, efficient, and relatively conservative in debt usage.
Moving on to Lotus, the net profit margin is only 2.5%, indicating weak profitability and higher cost relative to revenue. The ROA stands at 4.5%, showing modest returns from assets. With an inventory turnover of 3.0 times, inventory moves slower compared to Mr. DIY, which can tie up working capital. The current ratio is 0.9 times, which is below the standard safety threshold of 1.0. This could signal liquidity issues. The most concerning figure is the debt to equity ratio of 1.2 times. This is the highest among the three and reflects a heavy reliance on debt financing. In summary, Lotus is financially stretched and may face challenges in long-term sustainability if profitability and liquidity are not improved.
Now for 7-Eleven. While complete data is pending based on available disclosures, 7-Eleven shows moderate profitability but is particularly strong in inventory turnover, highlighting efficient stock movement. The company maintains good liquidity, generally above 1.0 on its current ratio. Its leverage is stable, with a manageable debt to equity ratio. This indicates strong operational execution, particularly in convenience retail operations.
Hi, let's take a quick look at the financial comparison of 7-Eleven, Lotus, and Mr. DIY based on 5 key metrics. The first one is net profit margin. Mr. DIY leads at 9.10%, showing profitability. 7-Eleven is estimated at 5 to 6% and Lotus trails at 2.5%. Number 2 is return on assets. Again, Mr. DIY stands out with 7%, followed by 7-Eleven 5% and Lotus 4.5%. Number 3 is inventory turnover. Mr. DIY 4.8 times efficient inventory management, Lotus 3 times. 7-Eleven marked as high, which fits their fast-moving goods model. Number 4 is current ratio. Mr. DIY has a healthy 1.3 times. 7-Eleven is estimated below than 1% and Lotus slightly below at 0.9 times. Number 5, debt to equity ratio. Mr. DIY lowest at 0.5 times, less reliant on debt. 7-Eleven 0.6 times to 0.8 times and Lotus is the highest at 1.2 times. Summary, Mr. DIY leads across most metrics with strong profitability and low debt. Lotus has tight margin and higher leverage. 7-Eleven is balanced but not as strong in specific. Thank you. Mr. DIY is a strong performer with balanced leverage and efficient operations. 7-Eleven excels in turnover and liquidity, supporting its fast-paced retail model. Lotus needs to reduce its debt burden and improve profitability and liquidity. Recommendations: Mr. DIY should continue expanding with controlled costs. Meanwhile, 7E can benefit from enhancing margin and innovating its product mix. Lotus should restructure its debt and re-evaluate its pricing and inventory strategy. Thank you.